Hey, all right, everybody, welcome. It is 3:30 Monday, March 12th. Thanks, everybody, for coming to the event today. I'm going to go through some risk stuff here, then we'll just jump right into it. All right, trading futures, options on futures, and retail off-exchange foreign currency transactions involve substantial risk of loss and is not suitable for all investors. You should carefully consider whether trading is suitable for you in light of your circumstances, knowledge on financial resources. You may lose all or more of your initial investment. Opinions, market data, and recommendations are subject to change at any time. Past performance is not indicative of future results. So folks, only fund a futures account with risk capital. That means money you can afford to risk or possibly lose without lengthening your retirement horizon or affecting your ability to maintain your lifestyle, etc. If you are unsure of whether or not this type of trading is something that could be appropriate for you, please feel free to have an objective discussion about risk with your representative in our office, whoever it is. Okay, we're happy to have a discussion about that. Another thing to mention, especially given the volatility, is be very conscious of the use of day trade margins. Okay, we offer a very competitive day trade margin here at Infinity because we want to be very competitive, but at the same token, use day margin gingerly. Understand that it can dramatically impact your leverage to the upside, which also impacts your risk. Okay, it's a double-edged sword. So let us know also if you have any questions about that and how it might affect your account. All right. Thank you again for coming. My name is Patrick Zielbauer, and I have been working with Sierra for many, many years. I've been working for Infinity for a long time, almost 14 years here. And today what I'd like to do is try to focus a little bit more than we have in some of the other presentations and just kind of go through the process of how I started to build this strategy that I look at every day. There's a tendency in these types of events, which if for those of you who are new, I do these every Monday, and they usually cover a different aspect of Sierra. But there's a tendency in these events to try to get more and more complicated with every one because a lot of the people who come are the same people, and we want to put fresh content in front of those people, and we end up really delving into things that are not interesting to the vast majority of our customers. So I would like to focus a little bit more this time on a process that you as a customer could go through and how to take advantage of this program in the way that we believe it should be taken advantage of. It's a great application. For those of you who are unfamiliar, we offer here at Infinity the use of Sierra for free if you do 10 round turns every 30 days. So if you buy one contract, sell one contract 10 times in a 30-day period, then the fee that we would otherwise charge for the charts, which is $20 or really just $19.95, is then waived. All right, so it's a very inexpensive account to maintain, and we do very good support, we believe, for the charting, and this is hopefully a good example of the lengths we'll go to try to make sure you can use this thing in the way that it can be used. It's a great application. All right, everybody can hear me okay? I just want to make sure one more time that the sound is good. Okay, all right, great, thank you. All right, so let's bring up the schedule. Today, I just put this in Notepad here. So this is what we're going to do. We already did the risk. I'm going to do a quick intro here about what we're looking at. And what I'm going to do is show, to start, I'm going to show a final product. And by final, I mean it actually does change possibly on a daily basis, but because I am continually working on this thing and editing it and trying to find a better way. And hopefully some of you here can help with that because we did talk about that a little bit last week. But I want to show you sort of what I was working towards. And then what I did was I built 5 chart books, which you'll see at the top that are labeled step 1, step 2, step 3, step 4, step 5. And the goal is to talk you through what I was thinking. And then each one of these gets a little bit more complex until we're a little closer to the final product. So this really should be a way for you to have a good example of how someone can think of an idea and then how you as a customer can realize that idea over time or with a little bit of effort. All right, so with that, I'm going to move this off to another screen. Sometimes I take notes in the notepad, so we'll make sure to send copies of these files to anybody who wants them. So if you want copies of these after the fact, you're welcome to request them from your rep in our office. Okay, it's 100% free. All right, so the chart or group of charts that we're looking at right now, I'm going to go through these first, and then we're going to go through some of the steps, and I'm going to show you some of the things that I did to get to this place. All right. This is a chart setup that I call the value area project. And just like many of you, I get every email and solicitation and newsletter and everything in my email every night. And I work with a lot of different people in the trading business who are in the education space, and just being at this for a long time, which many of you have been, you just start to pick up on certain things. So there's certain things about these places where you get information that you might really like, and then there's some things that you think are silly. And usually someone's strategy, whether it's working or not, is the culmination of input from a variety of areas. Very few times do we see someone work with like a particular educating group and then only work with that group forever and ever. Usually there's a couple things they pick up that they really like, maybe some of it they don't like, and then they move on. And the goal is to be able to do this on your own anyway, right? You don't want to be shadow trading your whole life. The point of this is to be able to have something that is independent, to you, and that can stand on its own feet. And so just like many of you, I have accumulated some opinions, and I started to build charts in a way that would reflect my biases. And that's what I would like to demonstrate here. So what I'm going to do is let's use this Dow chart here as an example, I guess. Does it have any signals on it? Yeah, it's got a couple. The Russell had a couple. Let's use the Russell. This has a few more. And what I'm referring to by signals are these little blue and red lines. So I'm going to maximize this for now. We're going to come back to this in a minute. But this is basically what the chart looks like when you're zoomed in a bit. All right, so there's some lines on the chart. There's some bars in the chart. It's not too cluttered. It's about to be too cluttered. If I were to add one or two more things, I think it could be. But let me first explain what each of these things are, and then we'll back out the thought process and then go from there. All right, so the first thing, the most obvious thing, these blue and red lines are essentially sell or buy signals. So I'll come back as to why they are there in a minute, but that's what those are. And those are not, this is not an automated system per se. It does require, some human input. So I don't want you to just stop listening right now and then go load this and run it on your live account tomorrow. That's not the point. But the idea is that to use Sierra in a way that can generate some output that is actionable. That's the goal. The profile on the right is a weekly volume profile, nothing fancy. Okay, all it's doing is showing us, the typical bell curve we see with a weekly profile. Now it's Monday, so a daily profile today and a weekly profile would look the same. All right, this is not looking back 7 days or cumulative or anything. Usually I like to leave it on a daily profile, a weekly profile that starts on Monday, because I like to see if we're at around the edges in the second part of the week. So what I mean by that is that as time goes on, it takes more and more volume to sort of shift this profile because it's accumulating volume. And if you see the market breaking out of its upper or lower profile later in the week, that is quite meaningful. It's just like the market making a new high or low on like a Thursday. All right, that's something that usually you're going to see a flurry of activity around that time. So the point of the volume profile is not much more than to give you a general idea of where the market has concentrated its activity. Sometimes people look at these things called low or high volume nodes, which would be like a price level where not a lot of trading happened. An example of how that could exist here would be, pretend that it's Thursday and the market's up here, but earlier in the week the market was down here. So you end up with this double distribution, looks kind of like that, where my mouse is. See, it's kind of like this. What you often will see is you'll see the market just blow right through that middle portion. So that would be an example of a low volume area where there just was not a lot of interest. Now again, it's Monday, so the weekly and the daily profiles are the same. Not the greatest example, but it does give you a general idea of where the market centered its activity around. All right, so that's what that is. You're going to see some colored labels here in the y-axis. They're very easy to understand. This light blue one up here is the high. All right, this one down here is the low. This light blue one here is P high, that's the previous high. And then down here somewhere is the previous low. Okay, so what I decided was that since I'm not going to be using a chart that has lots and lots of indicators on it, I do want to have a couple of notations related to areas of interest. All right, I would consider the high, the low, the previous day's high and low to be reasonable areas to watch for a flurry of activity, because this strategy has a lot to do with a flurry of activity. We'll get to that in a little bit. All right. Then what you're also going to see are, what you're also going to see are a red solid line and then a red dash line. and then you're going to see a green solid line and a green dashed line. So the solid line represents the value area high, and the solid red line represents the value area low. The value area is the area in which between these prices, 70% of the day's volume has been traded between. So when you hear someone in the video online or something saying the market is trading above value, a lot of times what they mean is that it's above this value area high. My value areas are based on volume traded, not time spent. For those of you who are interested or have heard of something called market profile and volume profile are similar but different. And the big differentiator is volume profile is based on number of contracts traded at a certain, in a certain range, and market profile, or otherwise known as TPO or time price opportunity profile, is based on how much time the market spent at a certain location. And that's where you see those graphs that have like letters like A, B, C, D all the way across from left to right. This is a little bit different. All right, so here we're looking at volume profile. So we care about actual contracts traded. And I do actually use the entire session for the volume profile. So mine starts. This really, I made this on another computer, but this really could be 1700, which would be 5 p.m. Central, until 1600, which would be 4 p.m. Eastern. So I do like to look at the entire session, not just like the day session. Sometimes when people look at time price opportunity or market profile charts, they only like to look at the day session because you might have a period of time at night where the market like sits at one price for 4 hours, and it gives that price more validity on the graph, but really it didn't trade much there. There was just nothing going on. So that's why I like to look at the volume profile. I want to look at actual trades, and I want to use the entire session. Okay, I'm not one who usually only looks at, open stock market hours or something like that. Okay. All right, so the value area high is the high end of that range, and then the value area low is the low end of that range. And then what happens is whatever that value is right now, that is projected back in history as a straight line, kind of like a pivot point. All right, so the pivot point could be different earlier in the day. If the market makes a new high or low or something and you're using today's data, it can shift the value. That's what happens here. So as the market trades, this range can adjust. And so what the dotted line is the dotted line represents the value area high. This green one represents the value area high at that time. All right, down here, the value area low represents this dotted line represents where the value area low was at that time. All right, I didn't actually know you could do that. There was a customer of Infinity who, I don't know if he's here today or not. Yeah, there he is, Brad, who pointed out to me that I could draw what's called a developing value area high and low, which I didn't even know you really could do. And to me, that's useful, not so much right now at the current moment, but it's useful going back in time and saying, okay, that's where the value area was when my long signal fired, or here's where the value area was when my short signal fired, because the value area now could be way different depending on the market activity. So it's a very helpful tool to go back in time and see where that range was. All right, so that's the value area high, value area low, and then the developing lines, which represent that where the value area high and low were at a certain point in history. All right, the volume point of control here is just the price at which the majority of the volume has traded. The fact that this is listed here is actually quite redundant. I could pretty much remove it. It's not referred to in any of my actual trading signals. So, and it's actually this pink line here shows it to us anyway. So it actually really goes against my general ideology to have this listed here because I don't use it at all. I really should hide that. In fact, I actually probably will. So you go to studies here. I'm going to go to the volume value area lines, and I'm actually just going to, oh, that one's already hidden. There's another one here, volume value area lines. I'm just going to hide that for now. Okay, so it's gone. So that's not referred to in any of my signals. So that's where we're at. All right, now at the bottom, you've got a CCI. All right, the CCI has values of 200 and negative 200 as its lines. All right, and that's really it. I mean, I know that it does look a little bit cluttered, but there's not that much on the chart. And we're going to cover, the strategy and the why here as we go forward. All right, does anybody have any questions so far about what is actually present right now on this chart in terms of just the studies? Okay, seems like we're on the right track. Okay. All right, now why the sell signals and buy signals? How did I come to this? Does it work? Let's get into all that. So the general concept with a strategy like this is something based around a theme in trading called reversion to the mean. All right, reversion to the mean means that if the market this is not a non-statistical explanation, okay, this is like a real person explanation, not a Webster definition. Reversion to the mean is the idea that the market sometimes makes outlying moves to the up or downside and has a tendency to come back to where it started, or at least close enough for it to make it worth paying attention to. All right, that's my interpretation of what that means. So reversion to the mean strategies are great because they historically work in choppy markets. So if you ever hear someone saying, oh, this market's so choppy, I can't trade it, that's silly. Okay, there's a lot of great strategies that work in choppy markets. The problem is that reversion to the mean strategies will fail often in trending markets. So the fact that the market is in a choppy market in and of itself is not an issue. You could probably trade this in a mean reverting market, kind of like we see here today, and do okay. The problem is we don't get a notification from the stock market when it decides to go in one direction and not stop. Right? We don't get a letter. I don't get an email saying, "Hey Patrick, by the way, the Dow is about to make a new high and it's not coming back for 800 points." Okay, we don't get that. So the problem for mean reversion traders is that they tend to blow out when something doesn't come back because they have no risk control, or they will add to positions until they blow out their account, which is not what we want to see, obviously. So part of the hard part about this type of trading is putting in filters to keep yourself out of these freight trains that could be a market running, right through the value area high and just never coming back. That's an example of which I'm going to show you from last week. All right, that was a great example of this. So last Monday when we had this presentation, I asked some folks for some input as far as what they would use as a filter, and I'm actually interested to see if anybody has any feedback. But there are some elements of subjectivity that are just cannot be eliminated in my eyes, and I'd like to cover some of that. All right. One of the questions that came through from Ron here was, can you describe the process for picking just these two signals? And basically, Ron, it was just the value area or profile is a very popular and common way of looking at the market, and I was looking for something that didn't happen very often. The market doesn't go through the value area high that much in a day. The market doesn't go through the value area low that often in a day. What I was looking for something that would generate, was something that would generate a couple of trades a day. So I thought, okay, let's look for an outlier event that doesn't happen that much, but happens enough for us to be worth it to sit here and look at it. And let's also look for a condition that when hit, usually we do see sort of a flurry of movement. One of those conditions would be the value area being breached. All right, especially later in the day. So if the value area is breached later in the day when all that volume has had time to accumulate, that is a significant thing to look at because it takes a lot of new volume, like a change in sentiment, for that value area to move itself based on new volume trading at higher prices or lower prices. So that was one aspect of it. The other one with the CCI, I'll kind of get to that in just a second. All right, I'll touch on that when we get into the next slide. Okay. RD says, why didn't you take the other two outliers? Okay, I'm actually not 100% sure what you mean by that, RD. I'm willing to answer, but I don't think I said that I took anything here or didn't take anything. All right, can you set an alert for the breaches of the value area high and low? Yeah, Ezra, the whole thing is based on that. That's what these blue and red lines are. So we're gonna touch on that, and that can be visual or an audible alert. All right. Okay. So the next thing that I was looking for was a second input that didn't happen constantly throughout the day. And Ron, to your question about why the CCI, why did I pick the CCI? Well, the CCI is a regular oscillator. It is not a mystery to me. It's something I've been looking at, subconsciously for a long time. And all of these oscillators have similar behavior. I mean, if you look at a stochastic or a MACD or a CCI, I'm not saying they all act exactly the same, and I'm not saying that one is necessarily better than the other, But what I was looking for was a well-known oscillator that I could follow where I could increase the number to a higher range, like I did here from 200 to from 100 to 200, which I'll touch on in another chart in a minute. And I was looking to combine these two things into one signal. So the signal comes, folks, when the CCI breaches this upper 200 level area, and at the same bar, the market goes up through the value area high. So again, the CCI hits above 200 right here, and then the value area is breached from below. So the market is going up, 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 up through this line. That's when you see this red thing show up. That would be in and of itself a sell signal, okay? All right, back here to the buy side, like this is an example of a buy signal. So this is the market breaking lower, 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 comes through the value area low. At the same time, the CCI breaches the negative 200 level. Oops, see down there? That's what generates the buy signal. All right. Ola, do you intend to present on zigzags? No, I do not intend to do that today, Ola. But I mean, I suppose you could add that in here if you have some feedback. I'm welcome. You know, I'm open to hearing it. Okay. So Al makes a comment that says, selling above value on an uptrend day spells doom. That's right. So what Al is basically saying is just because the market goes above its value area high, it doesn't mean it's going to come back down. We're going to touch on that in another chart here in just a minute. So you're right. You're definitely right. You need to have some protection in place, and you also have to be willing to skip trades that your gut says might be good trades, because oftentimes those are going to be the most wrong. And I'll give you some examples of how you can try to avoid that scenario in a moment. All right, so now that we've covered like just the basic idea of the strategy, let's go through. I would like to show you some of the mechanics, okay? Because it's not just the idea. What I want you to be able to do is not just take this. I mean, if you're welcome to take any piece of this that you like, all right? But you probably already have some things that you like to look at, or things you would like to say, okay, how can I simplify the look on the screen? That's what we want to show you how to do. All right, so the first thing I did when I was building this idea is I first added I made a brand new chart, and this is step one. I added the volume profile study. So Sierra has a study that's called volume by price. All right, it's down here at the bottom of the list, volume by price. When you configure it, it changes its name because you could make one based on number of days or weeks, or you could make it based on any number of things. It'll sort of change the name after you apply your settings, so it doesn't look like exactly it's the same study, but it really is, just with different configuration. And what I did was I said, okay, I'm looking for volume profile, and I wanted to make it so that each profile was based on 1 unit of time, and each unit of time was a day. All right, so that's what we see right here. Thanks, Ola, I appreciate that. So multiple profiles based on fixed time. All right, so I have that here, and I have it set to 1. So what that means is that we're going to get a different profile for each day. So if I were to scroll back in time or kind of squish this like this, we're going to see this behavior. All right, so there's a different profile for each session. All right, I'll zoom us back in. So then I'm looking at this, and I was saying, okay, I've got you can highlight the value area. There's a choice in here in the settings section where you can, and there's a lot of inputs with this study, so I know it's a little intimidating, but there's a lot of stuff you'll never have to change. But with these types of studies, there are lots of things that you can choose. Yes, I want to do that. No, I don't. In this example, I wanted to highlight the value area. So that defaults to no in most cases. I set that to yes. And then I want to extend the value area out into the future, which is what, in this case, the past, because I have the volume profile flipped, so it's facing this way. So that's what extend value area is. The point of control, same deal. That's this pink line. Do I want that extended? I said yes. And there's an option in here called right align volume bars, which I have set to yes, which is usually set to no. Now, granted, I understand I'm blowing through some of the fast, the little settings here, but you can have all of these files. So if you want to go through this process yourself, I'll send these files to everybody, and you can look at them, at your own pace as well. All right, so this is how we got to the point where I was like, okay, now I can at least see the value area. All right, but this wasn't enough. So what do we do? What do we do then? So I'm going to take us over to step 2 here. So step 2 is the addition of the CCI. So to add an indicator to a chart, just like you would any other study, you just go to the list, choose it. In this case, it's commodity channel index. I added it, and I might have changed some color settings, but in this case, you can see the values are still at 100 and minus 100. So I hadn't yet gotten to the point where I had made a decision that 100 was just too frequent. All right, it was just too frequent. So in other words, the market was hitting it too often. There's too many signals. We need to look for more events that are outlier type events, meaning they just don't happen as much. Okay, and so that's where we were with step 2. All right, now step 3. All I did here was expand the value area lines out to 200 and negative 200. All right, so the way to do that, and there's going to be lots of choices for each of these studies, and they're all going to be different, is you go to the commodity channel index and you can click on settings, or you can just double click right on the study itself, and you'll see the line 2 and 3 values right here. These used to say 100 and negative 200. So Bollinger Band, moving averages, anything that's got a numerical input, this is where you're going to make those adjustments. Okay, so there's lots of, some indicators have many choices, like the volume profile you saw tons and tons of inputs. If you just add a regular volume study at the bottom of the screen, it has no inputs. There's really nothing to pick. All right, with the CCI, with the MACD, moving averages, there's going to be some choices. So I changed that to 200 and negative 200. So now visually, as I look at the screen, I can see, all right, I can see when the market is hitting a value area low. I can see when it's hitting its value area high or breaching it. I can also see when the CCI is hitting above 200 or negative 200. The problem with looking at indicators on charts is that you are never looking at just one chart with one set of indicators. You're always doing it with 8 charts on 8 different markets with 6 different time frames. That is really what the problem, I think, is part of the problem in the trading business, is that the technology has gotten to the point where regular people like us can see tons and tons of data. It doesn't necessarily bode well for people who are not computers. All right, even the people I've got who are mathematicians by trade or developers, a lot of them struggle with decision making just like other humans. And there's a huge element of decision fatigue in here. I talk about it every week. It's real in trading. It comes to the forefront a lot faster, in my opinion, than any other business. You can only have a certain finite amount of quality decision making you can do in a day. And many of you, like me, have burned through it by 9 o'clock in the morning. So the objective here is to try to scale back the amount of focus you always have to have be on all the time. And that's where this color background thing happened. I didn't go into this thinking, hey, I'm going to paint the background color, a certain color when this happens. I went into it looking for the strategy. All right, it was actually a customer of mine who, I don't think he's here today, but who pointed out to me originally years ago the idea that I could do the color background stuff. That's where it all came from. So the objective here with this is to actually pare back the amount of data you have present on the chart and still see the information that you need to make your decisions. All right, so now we're done with step 3 here. Okay, so we're moving along. So in step 4, what I did was I realized that I didn't care that much about the volume profile itself. So I took it off. So that's when I switched from always having this visible profile. And I know that on our main project here, we do have a volume profile, but this is a little bit different because it's a weekly profile. There is zero short-term decision making made on this this thing here. It's really, for me, it's to see if we're making a new high or low into the week, especially at the end of the week. So that's why I don't really mind having this up here. Even though it doesn't have a direct impact on the decision making, it kind of sits in the background. I even made it really transparent so I wouldn't notice it that often. So I only really notice it when I'm looking for it. And because of that, when I was going through this process, I decided, you know what, I should probably remove it. Because really all I care about is the value area high, low, and even the point of control, as you could see I did away with on my other screen. Really don't even need that here. Although it does, sometimes people will say that the market, if it does revert back, that it tends to center around this area. So you could make some argument for having it there, but in this case, it's not 100% relevant to me. But the study that we're looking at, folks, is called Volume Value Area Lines. So I actually removed the volume by price study, and I added volume value area lines. All right, that was the next step. So this took a lot off of me because now I just have a few levels on the chart, and I don't have to make heads or tails of this complicated profile that is always diverting my attention back to it for some reason. All right, and the way that the volume profile is based in Sierra is so flexible. There's a million color choices. I mean, it's like this endless flexibility. If you set it up in a way that just looks really cool, you're just going to end up staring at it, and it's gonna sap your energy. All right. Okay, so then we got over to the step 5 here. So step 5 is where things sort of came together, and there were a few things that happened in step 5. Okay, one thing was the addition of the daily open, high, low, close values, which you can see are here. So these are slightly different colors than I made on the first version, or the first one we saw. But basically what I did here was I added 2 instances of the daily open, high, low, close study. So this is a great study. It's a very flexible study. It also has a midpoint option that a lot of people sometimes ask us about, like where's the midpoint, or how do I get the half back number or something. So if you go to daily open, high, low, close, and you go to settings here, the way to get this to show today's info is to put the reference days back to 0. So there's a common theme inside Sierra with pivot points, with daily open, high, low, close, with various studies where it asks you, okay, how far back are we looking right now? And you just want to remember that intuitively you might not think about it, but if you put 0, it means we're looking at today. There are a number of places in Sierra where this comes into play, where it offers you a choice, often defaulted to 1, meaning yesterday, of how many days back are we looking. Well, what I simply did was added 1 instance of the daily open, high, low, close study. I put this in the subgraphs. I hid the open. I hid the close. So those are both gone. And I just put the high and the low. And then I put a short name, high and low, so I could see them very clearly on the chart. That's what these labels are. So if you want these labels to show, that's what this little thing called name label is. And if you want the value to show on the y-axis, that's what this value label is. So name label and value label I have checked. And if you check name label, it's going to put whatever is in here, like in this case low. Okay, but if you put in your own short name, it'll use whatever that is. So that's why I'm only getting low right here. See that? All right. So I added 1 instance of that, and then I added another instance that looks at yesterday. So that's how we're getting the previous day's high and the previous day's low. And if you go to subgraphs, you can see I've got P-high and then P-low. So it's the same exact inputs. High and low only visible. The open and the close are hidden. Name label, value label, both checked. The only difference between any of these things is the reference days back is set in this case to 1. So that's how we're getting those values. All right, I also added a second instance of the volume value area line study with the same parameters, except draw developing value area set to yes instead of no. That's how we're getting the fluctuation in those lines, like right up here. So this line here and the solid line are the same study. The only difference is that one of them is set to draw developing lines and the other one is not. Draw developing value area lines, this one is set to yes. All right, and then now we're going to get to the fun part, and that is actually writing the signal, the code for the signal. And this does get into the meat of what Sierra really can allow someone who's not a developer or a programmer like me to build. I would also argue and concede that this is probably the most challenging aspect of it. So I'd like you to try to focus. Keep in mind that this is going to be up on YouTube within a day or so. So you're not going to have to remember everything we say here. You're welcome to watch it at your own pace. And we also have several other explanatory examples of how this works on our site. All right, I know I have to go pretty quick, Nat. It's just we only have so much time, and I just that's the way it is. But we do put them on YouTube. Okay. All right. So when you're writing these sorts of conditions, what I want to do is show you the condition first, and it's going to scare you, and then we're going to parse it out and show you that it's not that bad. So let's look at the first one. So the first one, color background based on alert condition. This is the name of the study that makes this show up here. So what you're effectively doing is adding 2 instances of it. One of them is for your sell signal in this case, and one's for the buy signal. So if I go to settings here, I'll just look at the subgraphs tab. This is obviously our sell signal. And what you're going to actually do is the code is going to go in the alert tab right here. So this is what the code looks like for this particular signal. And when you look at this, there's a tendency to just glaze over when you see something like this and kind of curl up in a ball in the corner of the room. All right, it's really not that bad. And so what I would like to do is show you how somebody can code something like this. And we're going to break it down, bit by bit. All right. So let's do that. Now, before we get to this point and go through that example, there are a couple of questions that came through. Ezra had asked, do you have a default stop and target level? And the answer is not really. I don't. Anytime I've followed this in a simulated environment in real time, I've never used a hard target. I have most of the time used a hard stop. And what I will say is that if you trade this kind of a strategy and you don't have nerves of steel and you don't use a hard stop, like Al said earlier, there will come a time where you get short the market and it just never comes back. So there's sort of a reality that one has to accept, and that is that if you don't have some sort of reasonable uncle point, this will not work, period. It's just math. It's humanity. We're going to make, it's a numbers game. It's going to get you, okay? You will make a misstep, and if you don't have some sort of a real risk program in place, whether it's a stop loss or whatever, there will come a time where it just doesn't come back. And, that's a reality. So a hard stop, I think, is probably a very good idea. A fixed target, I'm not necessarily certain that I would use a fixed target. And I certainly do not use a fixed trailing stop with this type of strategy. And there's a couple of reasons why that is that I hope to get to. Okay. So I'll get to that here in a little bit more in a bit. Larry, I'm not sure about excluding Sunday or holidays. I don't know if there's a way to do that. I look at the full session of data, so I never really thought to exclude those, even Sunday night, I include. What about using the value area, like the opposing value area low or high as targets? That was a suggestion Stu made. Certainly that is a reasonable way to do it. But I'll get to why I might not necessarily do that here in a minute, Stu, okay? All right. Okay, Al, I know you can't. I don't want to get sidetracked here because we only got about 20 minutes, okay? Larry, we can investigate that. I just never have done it with this particular strategy. All right, so let's go through the actual, the way that we get to the coding part. All right, this is the fun part. So the first thing that I would suggest you do is I usually bring Notepad over and I make notes either on paper or a notepad or something because there are a couple things that you want to be able to, refer back to. The first thing that you need to know is you need to know the ID number of each of the studies. I'm sorry, that keeps going off the screen. So I'm going to keep it on another screen for a second. When we need it, we'll bring it back. I don't want that to be distracting. All right, so the first thing again is we need to know the ID number of the study, and we need to know what subgraphs of the study that we care about. So as an example, a CCI could have several subgraphs because there's the line itself, and then there's another line here and another line here, and there's an average of the line you can have, etc. A MACD might have several subgraphs, okay? It could have the MACD line, the moving average of the MACD, the differential line, the zero line. These are all called subgraphs in Sierra. Something simple like a moving average will only have one subgraph because there's only one line. So the idea here is that you need to know the ID number of the study itself, and then you also need to know the subgraph number of the piece of the study that you're going to refer to. All right, so let's do an example of how we might get that. So the first thing we notice about the CCI, Commodity Channel Index, is that we've got an ID number of 2. So if we go to this subgraphs tab, we're going to see that here's the SG1, SG2, SG3, SG4. So the subgraph is SG1 for the CCI itself. So the way that we would refer to the CCI in this example would be ID2, which is the name of the number of the study here, ID2 dot SG1. All right, this means subgraph number 1 of study number 2. All right, then what you've also got is you've got ID2 SG3 and ID2 SG4. So you've got line 2 and line 1. I don't really know what line 1, this line here is in the CCI. That's always hidden. But if you go to settings and inputs, you can see this is kind of confusing. Line 2 is my 200 line, and line 3 is my negative 200 line. All right, so if we use those as an example, the upper CCI, so this one's the CCI itself. All right, the upper CCI is ID2. Let's go back and look just to be sure. ID2.SG3. Okay, that's the upper CCI. And then ID2.SG4, that's the lower CCI. So when we're writing our code, we're going to be using these values to refer to the CCI itself. Whenever you're referring to the current price of the market or the last traded price of the current bar, you're going to use the letter C. So C equals the current price, current or last price. All right, so a lot of times you're going to be referring to C, but in this case, we're going to need to know about C versus the value area high, the value area low. This is going to come into play a lot. All right, so let's head over to the volume value area lines here and use that, get that example. So the volume value area is ID1. We don't really care about the POC, the point of control. What we care about is SG2 and SG3. So SG2 is our value area high, and SG3 is our value area low. So let's do this. So ID1.SG2, that's our value area high. Okay, and then ID1.SG3, that's our value area low. So we pretty much have all of the pieces of what we're going to need for the code here, because this only looks at two functions, right? It looks at the last price versus the value area, and it looks at the CCI versus another part of the CCI. So everything we're going to need is now in this zone. So now it's starting to hopefully feel, just a little bit less daunting. All right. So let's go to our code here, and I'll show you how we came up with everything. So the first signal, which is our sell signal, is basically two pieces. All right. The first condition is related to the CCI. All right. Now, if you look at the CCI here, ID2.SG1 is greater than ID2.SG3. Okay. That means that the CCI is greater than the upper value of the CCI. So that's where that code comes from. So when you're writing this out and you're looking at this in your head without a key in front of you, like what we see on in the actual window there on the alert tab, you could say, okay, and you just spell this out in English. I want to know when the CCI ID2.SG1, all right, is greater than ID2.SG3, the upper line. That's why writing these things out like this is helpful. So there's a lot of greater than, less than, greater than equal to, less than equal to in Sierra. Most conditions are related to something either being above or below something else, or crossing something from above or below something else. So most of your conditions will be very, very logical. Okay, there are a couple of more complicated operators, but we're not even really going to get to them here. Okay, so ID2.SG1 is greater than ID2.SG3, and then the next piece of it is the act of the market crossing that value area high. So when you're using a crossing command, there's really only two of them, cross from above or cross from below. There's also one called cross over, but it's obviously not as specific. It doesn't matter which way it goes. In this case, it really does matter. We want to know when the market is coming up through that value area high. All right, so the way to do that is, in this case, we're using cross from below. Cross from below, and then you're going to use the current price, C, comma, and you can put a space or you don't have to put a space here, but you could if you wanted to, ID1.SG2, which is our value area high. So cross from below, this is crossing this from below. That's what this means. So we have two separate conditions that we then need to combine. And doing so is as simple as separating them by a comma. Let's just expand this out a little bit so we can have some more space. We're going to separate them by a comma. All right, and then encapsulate the whole thing in a parentheses with the word and in front, like this. So when you're looking at a code like the one you see in the background there, I didn't just sit here and just type that out like I was looking at the matrix. Okay, I went through and there are some people write codes that are many lines long, and it can look insane. But really, it's a lot of repetition, and it's actually just little pieces that are pushed together. In this case, one condition is right here. That's the CCI being above the upper level. And then this one here is the value area being breached from below. All right, so once you have that in place, you're going to put that in your field. Okay, I'm actually going to remove it here for a second, just so you can see what happens when it's not there. Okay, see the condition is gone. I just deleted everything. I put it right back. Apply. If it works, this is the behavior you're going to get. If you forget to do a parentheses or something like this, you're going to get an error message saying syntax error. Okay, syntax error in the alert manager like this. This means that you probably forgot a parenthesis somewhere, so just check your parentheses. I'm going to put this back and apply it, and it's there again. All right, now a lot of times when I am doing these studies, I will actually just copy and paste the code a second time into a new instance, or you can even duplicate the study. So you can actually hit the duplicate button, and it'll make an exact copy of what you already have. And then you need to flip some things around. So in this case, I'm not going to go through all this here because we're a little short on time. But in this case, we had to switch some things around. So if you remember, this is the CCI. Okay, look at that ID2.SG4. That's the lower CCI here. And then instead of using cross from above, or excuse me, cross from below, we're using cross from above. That means the market is coming down through the level. And it's C, comma, and instead of using the value area high this time, we're using the value area low, ID1.SG3. All right, so, and then we're just picking a color, different color. All right, so that's how we're generating the buy signal. So that is sort of how these things can come together. Yeah, Stephen also mentioned you could use equal. So you could use the equal sign as well. It doesn't have to be greater than, less than, or greater than or equal to. You can use equal. Although a lot of times with lines that have, that go into the 2 or 3 decimal places, they're not equal very often. So you have to make sure you're not filtering out too much. All right, but this is how the whole idea came together. All right, now what I want to do is go back. I don't think we're going to have time to get into the automated trading part of this today, but because there are some other things I really wanted to touch on that are related to this strategy, and I want to make sure we get them answered. All right. David said, sorry for the unrelated question. Oh, we're using Renko. Yeah, I'm not sure about the Renko, David. There's actually a page on Sierra's website that specifically talks about how to refer to Renko bars. So the answer is yes, you can do that, and it is definitely a different subgraph number, but I actually don't know what it is off the top of my head, and I actually think you're right. All right. Is the 5-minute my preferred time frame, Patrick? Ezra, it generates enough signals where it's worth the effort. I mean, I suppose you could certainly widen it out. I probably wouldn't go lower than 5 minutes. Okay, so one of the things that Al mentioned earlier was that, getting short the market on an uptrend day, especially lately, it can be obviously very dangerous. I would like you to look back at, let me scroll back in time here. Look at Friday. Let's zoom out. Okay, so what happened to you if you took this short and didn't get out, and then you took this one? All right, you sold the Dow here on 125. You sold it again 300 points later. This is a blowout kind of day if you are just sticking with it. So this strategy is in the wrong hands, could be trouble. All right, you really do need to have a place where you're willing to call it Uncle Point. All right, yeah, you go get a job, says Scotty. That's exactly right. So essentially, you have to have a fixed stop in place if you're going to do this. Or if it's not a fixed stop, you have to have a mental stop, and you got to be ironclad. I imagine most people here, like me, are not very good at sticking with fixed, mental stops. It's very difficult for most people to do because sometimes the market doesn't rip through that level. It kind of plods up to it, and it's like, well, if I just kind of move the stop, or I just wait another couple ticks, and all of a sudden it's 30 ticks higher before you had a chance to think about it, and now you're in some serious trouble. So you just do have to come to a realization that, if you let it get out of control, eventually it will, and that'll be the end of it. So just accept that as fact, and it just makes it so much easier. But one thing that you can do to avoid taking the wrong side of this thing is if all the markets at the same time are breaching the value area high, don't sell the market. Okay, so this strategy works best when sometimes these indexes get out of whack, which they have been lately, where the NASDAQ is up and the Dow's down, or the Russell's up and the S&P's down. They're not just all cranking in one direction. Sometimes when one of these or two of these get out of whack, things get confused and the market gets into this choppy, area. That to me is the best time to engage a strategy like this. So if you're going to do a reversion to the mean strategy that waits until the market breaches an upper level area, don't go short if all the indexes are making new highs in the day. All right, that's a good example of when you're looking at the chart and you're seeing these red lines show up on all four of these charts at the same time. That's why it's like, wow, this could actually be a buy signal. So here you have four different markets with four sell signals, and I'm telling you to go long. That's what I mean by how contextual the strategy can be. All right, because in the context of what's happening at that moment, it would be silly to get short when all the four markets are ripping through that upper area and they just don't look like they're slowing down. That's what I'm, sort of what I'm getting at. So there are situations where despite the presence of a sell signal, you may not want to take a sell signal. Just like there are situations where despite the presence of a buy signal, you may not want to trade, to the long side if all the markets are ripping through their value area low. But if one of them is, then you could make the argument that, okay, that's worth the risk. Another thing you could do is, and I did this with some of the automated stuff, and again, I'm just going to concede that we don't have time to talk about the automated trading here today. That will help me get some more valid points across, is you don't necessarily have to take the trade right as the market breaches that lower level. There are a lot of times where you will miss your trade if you don't take the trade as the market breaches the lower level, but it might keep you out of some trouble, and it also might save you a couple $100. When I was testing some of the automated trading on the NASDAQ, I would actually let the market go 5 full points, 20 ticks, through the value area high below before the system considered going short. And there were a lot of times, there weren't very many times where I missed that trade because 20 ticks in the NASDAQ is not very much. But but it would have saved you $100 here and there, for every contract that you took. So if you feel like the market is extended and these ranges are getting wider and wider, and you just feel like, wow, 10 ticks in the Dow isn't what it used to be, maybe 3 months ago, you can give this thing more room. You don't necessarily have to buy it right on the value area low. All right, but if you see a signal firing, that means the market is making a momentum move downward, and the CCI is going to be telling you that this is not usually sustained for very long. That's what the CCI being at negative 200 is going to say. All right. Yeah, we will have a recording up on YouTube within a day or so. Okay. All right. So just a brief summary. So this is an example of what a long signal looks like. Let's go to the Russell here for a second. All right. Let me zoom in on this a little bit more. Okay, so this is an example of what a long signal looks like. So the market's coming down, 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 breaches through the value area low, CCI is at negative 200. That would say this would be a long signal. So one thing that you also want to remember is that this is not like a 3-tick scalping strategy. All right, this is a strategy that might only generate a trade or two. Don't trade the strategy if you're willing to risk $75 a contract. It's not going to work. You're going to get stopped out every single time. I have plenty of clients who will risk $700 or $800 in a day, and they do it on 42 trades. All right, if you're going to risk $700 or $800, do it on 1 or 2 trades, and do it with way less stress and way less commissions. Okay, you don't have to take 40 trades with a 3-tick stop. You could just do 1 trade with a 120-tick stop. Same deal, same thing with less fees. So this type of a strategy, you need to be able to risk a few $100 a contract if you're going to make it work. $200 to $500 on a 1 lot. And it might sound like insane to those of you who have been taught to use a 4-tick stop. I just think that it's really hard to trade with a 4-tick stop. And a lot of times you're just going to chew yourself up. It's going to be really hard to stick with it. All right, because you're human, and even if you were a computer, a lot of that is just noise. How do you make sense of that? So I think it is very difficult to trade with that kind of a tight stop unless you are just really have a lot of experience and your entries are very, very good. Most people's are not. So my advice would be willing to take a few fewer trades and risk a little bit more money on the 1 contract or the 2 contracts instead of trading 1 contract for a 10-tick stop in the YM 22 times. Trade 1 or 2 trades with a 60 or an 80-tick stop. In this kind of a market, that could happen quickly. And the other thing that's a lot less stressful in my eyes about using a little bit of a wider stop like that is that you're just less likely to feel like you got picked off and then the market ran the other way without you. If you take a 70-tick stop in the Dow and lose $350, at least you'll feel like you were wrong. and it just won't feel as frustrating. It's a lot more damaging psychologically to feel like you're getting taken for 15 ticks 4 or 5 times a day, and now it's Thursday and you just got stopped out for, the 27th time this week. That is really difficult for people to come back from. So widening things out has a lot of good benefits. It doesn't have an immediate benefit for infinity because we're going to make less on your trades because you're going to be trading less, but the longevity we believe is best for everybody. And that's why we, oftentimes we will present in this way. So this type of a strategy, you're going to look back and say, wow, I mean, this from here, from this line to this line, that's, that's a terrible example because that's only 1 point. So this one actually was a great long because it was only a 1 point, of heat basically, roughly. But there's going to be situations where you're going to see, hey, look, if you would have gotten short right at the value area high, you might have had to ride that out for a while. All right, that's a reality of trading a strategy like this because you're effectively calling a temporary top, which is hard to do. All right, so let's look back. So then there was a sell. Here's a sell signal. Let's talk about 2 other things. Well, yeah, this is a sell signal, so we already talked about this one. Here's one that was in the middle, well, not the middle of the night. This one was early in the morning. A lot of times I've questioned whether or not you could take a trade like this in the morning. A lot of times, around this time of day, 4:45 or so Central, a lot of the excitement is over. A lot of the European moves happen before this time. So around this time is where I would start considering looking at these trades. I really probably wouldn't take them before the European session really makes up its mind. But after about 4:40 or 4:30, I think that there's a little bit more validity because a lot of times you get a lot of chop around that time up until 7:30 when the economic data comes out. So I think around that time is a decent place to look. Plus, if you take it way too early, remember you're looking at a value area that is going to be changing a lot more last night and in the middle of the night than it is now. Because remember, the value area is based on how many trades or how much volume is happening. So earlier in the session, it takes less to move the value area than later in the session. If you start looking at it way too early, you get a more volatile value area that just doesn't mean as much. So a little bit later in the session, I think makes a little bit more sense. I think around 4:30 is when you could start to see it become worth it. Here is one in the Dow. Let's see. This one. This came in the middle of the night. This was in like 11 o'clock trade. So I highly doubt anybody would have caught and stuck with that one unless they were, running it completely automated. All right. And then I think there were a couple in the NASDAQ as well. Yeah, this one. Yeah, see, this was a little early in the morning. I mean, this one turned out okay with the benefit of hindsight, but probably wouldn't have taken that. All right. And another thing, what to look for, what are some filters you can put into place? Well, just before because we have only a few minutes left, there were a couple things that were important to me when I started really coming up with this idea, and one of them was crude oil. And I'm going to put crude back on the screen here. It's basically this little dotted line that I have overlaid from another chart. I had it hidden most of the time because it hasn't been particularly relevant. But when I first started making this strategy, it was when crude was down to like $35. Remember that? And every time crude would fall, it would take the stock market with it. And so what I did was I added crude to the chart because if you had a great long signal, it might be because crude's making a new low, in which case, watch out. You better not take that long. So this was an effort to filter out bad longs. As crude became less and less relevant, I started hiding it. So you can hide an indicator. In this case, it's an overlay study. I'm not going to talk about it today, but everyone can have the file. And it's basically being overlaid. And what I was doing was just trying to keep an eye on crude oil to see if it was getting crushed as the market was giving me a buy signal, but it would have been a bad buy signal. Many times it would have been a bad one. So again, just context. You have to look at the broader market. Lately, we've seen a lot of movement in the yen and the bonds. A lot of my clients follow the tick on the top right here. That's the NYSE tick. So I have an NYSE tick chart here with the yen, bonds, and crude. So the yen, as many of you know, tends to operate inversely to the stock market. So, not always, and that relationship comes and goes. But I've been looking for ways to try to filter out some of those, those bad days. So an example of a way to do that might be to look at correlated markets to see if they show conviction. So if the yen is showing a significant, upside momentum, and you're getting a buy signal on your Dow, you might want to pass on the Dow. because if the yen is rallying, that usually means money is coming out of the stock market and going into the yen. All right, bonds also, sort of a flight to quality, and a lot of times you can see move in concert with the yen. Look at that. This is the bonds here, and this is the yen. So having your eye on some other things, that may impact your decision making is not necessarily a bad thing if you're going into it with the objective of using it as a filter for a bad signal, not because you're trying to wait for 18 different things to all line up in the perfect way. They never will. All right, the tick, sometimes people look at this where they're looking for the market to reach these extended values. So for example, if the market is breaching that value area high, and as it's happening, the tick is already above, let's say 1,000 or 800 or some extreme level, that might make a stronger case for that short, because usually that market doesn't, that tick indicator does not stay up there for very long. It too, like the CCI, will revert. And this is a measurement of how many stocks are ticking up versus down at that moment. So if you see that number at an extreme level, a lot of times it doesn't stay that way. So there are plenty of ways for someone to take markets or opinions that they have already developed and integrate them into this process. And the objective here, as I said, is to try to simplify things. There's really only two major factors to generate to capture your attention here, which is the buy or the sell signal, and then from there, you have some decisions to make as far as what to do. So I think that's probably where we should leave it, today. There are some studies on this chart we didn't really have a chance to get to, but we did cover these in some of the other events recently that are up on YouTube already with the trading, related to the trading systems. These are both set. I'm going to set these send orders to trade service to no, which means that there are some signals on here that will fire trades, but I'm going to set it so that they won't actually send the trades. If you want copies of these, then you could just send an email to your rep in our office and we will get a copy of all these files to you. Just be aware, okay, that if you go into this study and you turn on this trading system like this to yes, send orders to trade service to yes, and you're connected to a live account, you will get trades, okay? So don't come back to me later and tell me you didn't know that. Make sure that you are aware of the studies that are on the chart. And if you want to be absolutely certain, you could just remove these last two studies off the chart and just click on remove to get rid of them, and it will remove them from all four of these studies, because these charts, or excuse me, all four of these charts, because these charts are linked by study. So when I make a change to one of them, I make the change to all. So as an example, watch as I uncheck the hide button for crude. Okay, push apply, you're going to see crude show up on all these markets, or on these charts again. All right, if I hide it again, you're going to see it disappear. All right, so these are linked by study. So if you remove the trading system based on alert condition, which is using essentially the same conditions as the color background, then you don't have to worry about it. But just make sure that you don't go in here and change send orders to trade service to yes, unless you want to use this as an automated system. Okay. Scotty, yeah, we have TRIN and up-down volume. So all the market statistics, Scotty, are under file, find symbol. They're all under market statistics, market stats. So the ones that you were probably looking for are TRIN-NYSE, which is this one. And then the up-down volume, I believe you're referring to the net issues, which is also the advanced decline ratio, or not the advanced decline ratio, but the advanced decline. That's NYSE net issues. And if you're looking for net volume, there's NVOL here, which is NVOL-NYSE, which is probably one that you might look at. All right. Okay, cool. All right, so fantastic. I think that's probably where we will leave it for now. I appreciate everybody listening to the event. Please tell your friends, your buddies, trading buddies, to come check us out. Hopefully you find value in these types of presentations. It really means a lot to us if you bring your pals. All right, it's a big deal for us. And I would like to do more and more of these types of events. And so if you can bring some trading buddies your way, or our way, that really would help us continue the educational outreach. All right. Thank you again for coming. Appreciate your time. I'm going to read some risk stuff one more time. We'll close the room up, and then we'll get the recording up on YouTube within a day or so, and we'll see you next Monday. Yeah, Scott, if you want a copy of the file, just email your rep in our office. That happens to be me, and we'll get you everything you need. All right? Okay, folks. Thank you. Everybody, we'll see you next time. Thanks again. All right, trading futures, options on futures, and retail off-exchange foreign currency transactions, that means Forex, involves substantial risk of loss and is not suitable for all investors. You should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and resources. You may lose all or more of your initial investment. Opinions, market data, and recommendations are subject to change at any time. Past performance is not indicative of future results. Thank you. Everybody have a great night. Thanks again for coming. It means a lot. Appreciate it. Bye.